Let's welcome in Blackrock's Global Chief Investment Strategist, Wei Li. And could you please give us your forecast? By the way, it's great to see you here. Could you please give us your forecast of what you expect tomorrow? Because this is 50% of the Fed's dual mandate. A lot of eyes on this report.
Hi there. Good morning. Thanks for having me. So in terms of the jobs report, I think given how strong earlier momentums are, it's possible that we could see kind of headline decrease. But I would say that our focus is really solely, mainly around the participation rate, because labor shortage has really contributed to this supply-shaped environment. So if that starts to be alleviated, certainly that would have feed through to inflationary dynamics, and that would feed through to market pricing for rate hikes and also broadly risk sentiment as well.
And let me ask you just generally about some of the central bank actions we've seen around the world over the last 2 weeks. A bit of a 180 by the Bank of England, now buying bonds, albeit for a short period of time, ostensibly speaking. Also the Bank of Japan buying the U.S. dollar, buying its own currency, the yen, trying to strengthen that versus others as well as the U.S. dollar. What are you seeing in the global effects world, and what implications do you think this might have for equities, especially as we consider these jobs numbers that you just explained to us?
I think what we're seeing really is a result of this supply-driven new regime that we're in, whereby given the fact that inflationary pressure comes from supply bottlenecks and supply shortages, then it's a lot harder for central banks to fight that. Their tools are primarily focused on addressing the demand side of the equation. So you talked about Bank of England going from announcing QT to start buying bonds. Obviously, there are specific kind of fiscal development in the UK that led to the bond buying, but more broadly, it just goes to show how difficult it is for central bank decision making in this supply-driven environment, characterized by tougher trade-offs. And you also talked about Bank of Japan and more broadly policy development and currency as well. I will make one observation. So far this year, depending on where you are based, depending on which currency you are denominated, your experience of the global market returns can be vastly different, right? Part of that is the dollar strength, but it's more than that as well. So dollar in the near term is very much driven by rate differential as well as global risk on and risk off sentiment. So far it has been very strong. But given the fact that how much currencies are contributing to the experience of investors of the global markets, we think that it's actually really important when we think about asset allocation to consider where our investors and clients are based in, which is why we're rolling out regional asset allocation. So, for example, I am sitting here in the UK, and we recently rolled out Euro asset allocation views. So really from the perspective of euro-denominated investors, how their asset allocation could look like versus a dollar-denominated investors. And that is critical. Being local is critical in the context of elevated macro uncertainty and elevated currency volatility.
Yeah, call it par for the course versus, I guess, based on this trend of deglobalization that we've seen over the last 5+ years. Now, I want to talk a little bit more generally about we saw the U.S. dollar strengthen versus most currencies quite considerably. It's backed off of that. And the other part of the equation there is with an easing U.S. dollar in the short term, we're seeing a bid for commodities. Now, we've been talking a lot about OPEC Plus and oil, but I want to focus on silver, gold, and some of the other commodities that we've recently catch a bid. A lot of people have either been waiting for gold to catch a bid or have just counted it out entirely. What do you think of the precious metal complex right now?
Well, exactly as you framed, the correlation between the dollar and precious metal has been in place. And I think in that context, as dollar weakens, you talked about how the risk on the sentiment earlier in the week led to a weaker dollar. It has been somewhat supportive of commodities and precious metals for that matter. But I would broadly say, though, the importance of diversification cannot be overstated in the context of the world that we're entering into, right? So thinking about the macro environment, we're currently expecting a recession this year in Europe, in the UK, and next year in the US. And at the same time, risks of central banks over-tightening policies into restrictive territories in order to fight inflation. The risks of that have risen significantly recently, but also certainly versus beginning of the year. So in this kind of environment where it makes sense to be more prudent when it comes to asset allocation, when it comes to portfolio risk taking, then having diversification in portfolio makes sense, and certainly gold has played a role in that. And I think that is also part of the considerations behind recent price action.
We got a time for one more, a bit brief here, but I want to talk to you about the Chinese yuan and also policymakers there. We've seen the yuan strengthen against the Japanese yen about 12% year to date. Yen has weakened considerably, and I talked about the measures by the BOJ before. Do you think the PBOC intervenes in the yuan here, and what consequences would that have for global risk assets?
Well, I think more broadly, when we talk about the Chinese yuan, we also have to talk about the Chinese economy, right? So what has happened so far this year is that there has been significant headwind for Chinese economy from the perspective of the zero COVID policy, acting as a dampener to economic reopening momentum. And at the same time, previously, the Chinese economy was supported by the tailwind of global exports, right? Like when the rest of the world was in shutdown, they export from China, and the demand for that has added to strong momentum last year. But now the rest of the world is switching back on, and China is in zero COVID mode. So that export tailwind is fading away as well, and both of that act as headwind and challenges for Chinese economy this year, and the Chinese currency movement so far this year are a reflection of that. You talked about versus the yen, but also versus the dollar. But of course, the dollar story is beyond more than just Chinese yuan. I would say one thing though, as we kind of head into next year, some expectation needs to be baked in around the restart momentum. Obviously, a lot contingent on how the COVID policy would evolve. But in the same way that the US economy opened up with strong momentum, European economy opened up with strong momentum, we certainly expect higher growth levels next year versus 2022.
Suffice to say, lots of moving parts here. Really appreciate your insights. As always, Wei Li, Blackrock Global Investment Chief Strategist, thank you for your time.